Don't. Susan's a partner with MMP based out of Vancouver with more than 2 decades of experience in economic modeling, applying economic analysis and project management. Susan helps clients achieve their business goals and enhance their success. It's a real privilege to have her here this morning. She delivers demand forecasts, prepares community profiles and economic indicators for economic development agencies, models economic impacts and labor demand, develops cost estimates and prepares business cases. She analyzes information. You like data, don't you?
I do.
And so do we. So it's great to have you here, and I'm not going to delay any further. It's great to have you with us. I'm going to stop sharing mine and turn things over to you, Susan. Hopefully, is it transitioning to spring in Lower Mainland there? We're a little bit slow. We go back and forth here, but
yeah, it's trying. It's trying. It's still gray and wet, but it's definitely warmer than it has been. So.
We have lots that have joined us, so we're going to turn things over to Susan to run us through the presentation and share the data she has. We promise we'll get you out of here in 60 minutes or less. If you have questions, there will be opportunities for Q&A. You can use the Q&A button and post your question at any time, though we will reserve those to the very end of the presentation, and I'll facilitate that Q&A. And if you want to use the chat function, you can potentially use that, but we ask just put your question in the Q&A and I'll monitor that, Susan, and I'll provide that and facilitate that at the end. So I'm going to turn things over to you, Susan. Thank you for joining us.
Great, thank you, Dan. It's great to be back speaking with everyone again. Before I jump into the data in the presentation, I want to begin by acknowledging that I'm speaking with you from the traditional territories of the Coast Salish peoples, specifically the Squamish, the Musqueam, and the Tsleil-Waututh, and that is where I live, work, and play. So with that, I want to just start by talking a little bit about how we got here. So last fall at the Economic Summit, we came together to talk about recovery from the pandemic and opportunities to grow the Southern Interior economy through collaboration. As part of that, we'd worked with the Chamber and other partners to put together a baseline snapshot of where things were and how we had gotten there. So I want to begin by just looking at the 3 important trends that emerged from the data at that time. And the first thing was population growth, which is playing a really big part in what was happening in terms of economic growth in the Southern Interior. And not just in the Southern Interior, this is something we've been seeing across BC for a while. And that's where we start to see some regional differences in that population growth. So between 2016 and 2021, the region added about 60,000 people, which is a bit less than 1.5 times the population of Vernon, and equivalent to the entire population of the Central Kootenay Regional District. And so that's a lot of people to be adding to the region. But those people weren't added uniformly across the region. They were actually concentrated in the urban areas. And I'm going to talk a little bit about that when I talk about population growth in a few minutes. But with all of that population growth, there comes demand for housing and a lot of services to support people in their daily lives. And so we saw a lot of growth in those kind of personal services and retail. And those kind of things, as well as construction with housing, since when you have people coming in, you need a place for them to live. So that was the first big factor. The second factor was that traditional economic drivers in the region were somewhat stalled. Forestry was stable. I think stable is the best way to describe it. After a series of economic shocks that included the imposition of tariffs on exports to the US following the expiry of the Softwood Lumber Agreement in 2015. There was a number of poor market conditions, a number of years with poor market conditions. And there's also reductions in access to fiber supply. And that the fiber supply had been shrinking for a number of reasons, including forest fires, but also just past activity. And so the forest industry is facing, had gone through a period of rationalization and was facing some real challenges. Mining has been stable. Though there was some expectation that we were going to see increased exploration activity. And I'll talk a little bit about that as well later when I talk about what's happening with mining, because that's still a trend that we're seeing. And then within the other key sector, agri-foods, we've seen a lot of growth in craft alcohol production. Well, agriculture was relatively stable. So we were seeing, good things happening in terms of produce and crops. little bit of growth in wines, craft cider and craft beers where most of the growth was. And there's also a distilling industry starting to emerge. And then tourism. Well, tourism was one of those, I guess, one of those industries that was hit hardest by the pandemic, but it had fared reasonably well in the southern interior. And that's because tourism market is regional. So when everything shut down in 2020 and we were allowed to just move around the province, you saw a big influx of visitors going into the Okanagan and areas because that was the only place people could go for a vacation. We saw similar trends in 2021, even though you could go interprovincially, the borders were still closed, so we still had to stay in Canada. And so in both those periods, we saw visitation up a lot relative to pre-pandemic levels. And then what happened last summer was as border restrictions have been lifted and there was a bit of revenge travel where people were leaving BC to go other places, a lot of trips to the US, a lot of trips to Europe. And so in the southern Okanagan and parts of the southern interior, what we saw is a drop in visitation. So your summer season looked more like pre-pandemic than it did those pandemic years where you had that elevated thing, and that had a big impact on things. And so while you had all these typical drivers of economic growth stalling, we started to see inflation rising and labor shortages emerging. And these are two things that came out of the pandemic. And there's, you know, at the start of the pandemic, we, as economists, thought this was just a transitory thing. We had supply chain bottlenecks and, you know, a shift from consuming services to goods, which was causing the prices to go up. So we figured that as supply chains unsnarled, we'd probably see inflation start to come down. That wasn't the case. And about a year ago, the Bank of Canada started to increase interest rates, and that's had a really big impact on where we are today. And so where are we today? Let's start by looking at the big picture. So GDP, or gross domestic product, is our standard measure of economic growth. And we've been fortunate in BC leading up to the pandemic that we were the fastest growing province in Canada. And that a lot of that was being driven by, as I said, population growth, but we also had some things happening up north that were creating a lot of demand for construction services. There's the LNG Canada facility being built on the coast, and there was the Site C Dam. And then, of course, we had a lot of people moving to BC, which was creating demand for housing and goods and services. And so leading up to the pandemic, things were good. The pandemic hit, like everywhere else in Canada, our GDP took a big hit in 2020, but we bounced back pretty quickly. And part of that was because people kept moving, and those infrastructure projects in northern BC kept moving. So this was all good. But right now, we are actually about to see a change in that. We're starting to see a change. Our infrastructure projects in the north are starting to wind down. So the pipeline is wrapping up construction. The LNG facility will be, I believe, is coming online in 2025, as will be Site C Dam. So those will move into operational mode, which has a lot less economic activity associated with it than when you're doing a big construction project. We've also seen that higher interest rates are curbing the housing market, and that is they're also having a really big impact on consumer spending. So going forward, BC, instead of being among the fastest growing regions in the country, we're probably going to be sort of in middle to bottom growth, and then in the near term is the expectations. One of the big factors in that is that BC households have one of the highest debt levels in the country. And so with the increase in interest rate, that makes our consumer spending very sensitive. And if you saw the numbers that came out about consumer spending and retail spending recently, you see that in places like Ontario, retail spending was up about 8% year over year. In BC, it was only up about 2%. So that's what we're starting to see. And then, as I said, the infrastructure projects are wrapping up. And in terms of our resource sectors, that's mostly for stability as opposed to growth. So overall, we're looking at entering that slower growth period. And a big part of why we're entering this period of slower growth is those rising interest rates, which are intended to curb inflation. So it was just over a year ago that the Bank of Canada started raising interest rates, and it takes time for that to work its way through the economy. Generally, the expectation is that an interest rate hike that happens today is going to have its full effect over a period of about 18 months. So right now we're 12 months in from when those first interest rate hikes started to happen, and we are starting to see inflation come down, which is a good thing. March data were released yesterday, and we're sitting at about 4.7% in BC and 4.3% nationally. And so by the end of the year, the expectation is that inflation is going to be closer to 3%, which is the upper end of the bank's inflation target. And then by sometime next year, it should be back to 2% unless there's some unforeseen shock. So the question we always get when we start to see inflation come down is, when am I going to get some interest rate relief? Well, if things continue as they have been, there may be some relief expected in mid to late fall, and that's kind of where the markets are right now. They're expecting possibly the Bank of Canada to cut rates towards sometime in the fourth quarter. However, when we start talking about rate cuts, it's really important to recognize that the 8 to 10 years prior to the pandemic, we had historically low interest rates. I've seen a lot of commentary recently describing the current state of inflation and interest rates as historic, which means you haven't really, if you're saying that, you probably haven't really looked at history, because the fact is that the interest rates prior to the pandemic were what was historic. And so as we look forward and start thinking about what does a rate cut look like, I wouldn't expect things to return to the pre-pandemic levels once inflation is under control, at least not in the near term. Or, we'd be looking at if the Bank of Canada's rate somewhere in the neutral zone. It's not, it's probably, we're probably still looking at 3 to 4% interest rates. So that's one thing that businesses and consumers are going to have to get used to is, the time when money was cheap, it may be over. But as economists, I'll just temper that a little bit. We're really good at looking backwards and telling you what happened. As indicated by the pandemic, we didn't really see everything that was going to happen, and we missed some big things like the whole consensus that inflation was just transitory. So we'll see what happens with those borrowing rates as we go forward. So what does this all mean for the Southern Interior economy? I want to start looking at population growth, which, as I said, was a big driver of growth both in BC and in the Southern Interior. With population growth comes demand for housing and other services, and such as retail, personal services, and repair, just some examples. So in 2022, as restrictions lifted, we saw population growth both in BC and in the Southern Interior increase significantly. So through the pandemic, there wasn't a really big drop in our population growth rates because people were coming here from other parts of the country. But as soon as those restrictions were lifted on borders and some of the backlog in immigration applications started to be cleared, we saw a really big increase in population growth rates. And so a lot of that increase is immigration, and to a lesser extent, migrants from other parts of Canada. So I wouldn't, we have new immigration targets that have been announced by the federal government. We're looking at a significant number of people coming to the country every year. So we do expect to see elevated immigration going forward, and the Southern Interior will certainly get a share of that. There will also be continued migration likely from other parts of Canada. And when you start to look at the individual regions, what you see is that there's differences in where people are coming from and who's coming. So in the Okanagan and the Thompson Columbia, most people are coming from outside of BC, and this is where most of our immigrants are going to. They tend to be relatively younger and are coming for economic opportunities. Migrants that are coming to the region from within BC, excuse me, tend to be relatively older, and they're more likely to be relocating with the intention of retiring here. In the Kootenays, the vast majority of migrants are from outside BC, and they tend to be relatively older. However, during the pandemic, there was an increase in younger people migrating to the region, and only time is going to tell if that continues. And you sort of see these trends if we look at the individual growth rates by region. So you see that in the Okanagan, it's been relatively stable. We've been tracking similar to the province as a whole, and you saw that big bump in 2022 as we saw those immigrants come in. Similarly, we've seen the Thompson-Columbia region around Kamloops and that, where they've had strong immigration growth and a big bump last year. You didn't see quite the same bump in the Kootenays. There was a bit of a bump, but not the same bump there. As I say, most of the people are coming from, the Kootenays are coming from outside of BC, meaning and other parts of Canada. We're not seeing large inflows of immigrants there. Most of the immigrants are going to the Kamloops area or the Kelowna area. And in the Hope Fraser Valley, there's actually was a decline in people in that area in 2022. And so these trends are relatively consistent with the fact that Kelowna and Kamloops are the main urban centers in the region, and that is where people tend to go because of the services that are there and the existing supports. They often have friends or relatives, and that's where they're going to. So if we have this growing population, and a lot of them tend to be younger people, that suggests we should be seeing growth in labor force and employment. And we've heard a lot about the labor force over the last year and a half or so because of labor shortage. And so if we look at what's happening here in the region, what we see is that if we compare the average employment levels in 2022 to the first quarter of 2023, we see in the Thompson Okanagan employment is actually a little bit down. There, well, in the Kootenay, it's a little bit up, but I would say probably looking at those numbers and knowing the variance within the underlying data, that it's been relatively stable. Now, it's important when we're looking at this to think about the fact that there's a seasonal component to a lot of the employment in the Thompson-Columbia and in the Okanagan. And that's because forestry, tourism, and agriculture, which are big industries, which are big parts of the economic base, all have strong seasonal trends in work and employment. So we would typically expect to see a decline in employment in the winter overall, and then to see it increase through the spring into fall. So if I compare the 2020 or Q1 of 2023 to Q1 of 2022, we see that employment in the Thompson-Columbia and the Okanagan is relatively stable. So we haven't actually seen a drop. It's just kind of sitting around where it was about a year ago, which is not necessarily a bad thing. So let's see what's happening to the unemployment rate, because we've heard about all sorts of labor shortages. And if we look at the unemployment rate, what we see is we've got a declining unemployment rate. On it, and which is consistent, as I say, with what we've been hearing about tight labor markets. But that really isn't the whole story here. So if we have employment that's similar to what it was a year ago, and unemployment rates that are lower than what they were a year ago, that suggests that we may have lost some people from our labor force, and that can be a bit of a concern, is it? So if we look at the participation rate here, what we're seeing is that participation rates across the province are a little bit lower than they were a year ago. And that trend is also apparent in the Thompson-Columbia and Okanagan. Whereas in the Kootenay region, we haven't really seen a fall in the participation rate. Part of the reason we may not have seen a fall in participation rate in the Kootenays is because that's a relatively small region and has a relatively older population and one of the lowest participation rates in the province. So it hasn't been affected by some of the same trends in the labor market as we're seeing overall at the BC level or within the Thompson-Okanagan. Now, so if we're seeing people leave the labor market, as I say, that's a bit of a concern. There's a couple of different explanations that could be what could be happening here. Number one, people could be retiring, and we have heard that there's a lot of people that are approaching retirement age. So people could be exiting the labor market for retirement. Another reason that people typically exit the labor market is they may not have been able to find a job, or there may be some barrier to them finding a job or working. And so this is actually a bit of a puzzle right now. We wouldn't expect to see labor force participation decline in a really tight labor market because typically we would see wages going up, and we have seen some upward pressure on wages. So this is a bit of a puzzle that suggests that there may be some barrier to people participating in the labor force, or we have seen a bunch of people retire. Given the inflow of young people, it's more likely that there's some sort of a barrier. We know that during COVID and that during the pandemic, there was issues with childcare, which could be an issue for women, which continues to be an issue for women. There has been challenges obtaining childcare. It could also be that there's a skill mismatch. So as people left their jobs before and transitioned to new jobs, maybe there's not people in the market that have the skills employers are looking for, or it could be that expectations about compensation are not being met. And this expectation about compensation comes back to sort of the inflationary environment that we're in. There's been a lot of talk about, labor shortages, and that it's really a seller's market in the labor market as opposed to a buyer's market, meaning employees could have the upper hand in the sense of in negotiations and so on. So maybe there's some disconnect there. And that's one of the reasons that we want to have low and stable inflation, is so that we don't run into those kind of mismatches potentially. Regardless of what the reason is, and I don't know which one of those is the most likely explanation because we just don't have the granular data at this point to be able to say, it's a sign that economic activity is slowing. And since employers aren't going to be able to add people if there's no people to add, or people aren't able to find jobs. So either way, the way you look at it, this means we're heading into that period of slower economic growth. We're also starting to see signs of slowing economic growth in the bankruptcy numbers. On the consumer side, bankruptcies are lower than pre-pandemic, but they're sort of in line at the provincial level in 2022 with what they were in 2021. But what we're seeing, if you go down into the quarterly numbers, you're seeing that the number of people starting the process is increasing each quarter. And so with interest rates, we continuing to rise and probably staying where they are for a while longer, we expect these numbers are going to increase in the near term as well. Are we going to get back to pre-pandemic levels? A lot of that's going to depend on what happens in the labor market. Even that we have this low unemployment rate, we're not seeing huge, we're not seeing a lot of big job losses at this point. But as, and if that continues as things soften, it'll certainly help some households avoid bankruptcy proceedings. So we don't expect a huge spike. We do expect an increase, but not a huge spike. When you look at business bankruptcies, you start to see a bit of a different story there. What has happened here is that business bankruptcies have increased significantly, both year over year, both 2022 relative to 2021, but also relative to pre-pandemic levels. And so the industries that are most affected, where we're seeing the highest levels of bankruptcy, are hospitality, construction, and retail, which are not, to me, that's not surprising. We know that construction is, very sensitive to interest rates. And we know that the hospitality and retail industries have come through some really difficult times with the pandemic and now having to deal with inflation. It also sort of, I want to also mention here that there's been a lot of discussion about inflation and questions about whether businesses are using inflation to boost profits. But I think this illustrates that the reality is that for most businesses, profit margins are being squeezed. A lot of retailers and hospitality employers are having difficulty finding staff, so they're not able to operate at full capacity, which means that they need to earn more from the capacity they have to cover their costs. So even though prices are going up, that doesn't necessarily mean profits are. I'm sure that there are businesses out there that are, engaging in what we call greedflation, but I would say the vast majority of businesses are feeling the same pressures that consumers are on their profit margins. And that's kind of what we've been hearing and talking to businesses around BC. So now if we look at what's happening in key industries, what you see is there's data that's available, the updated data from last fall for two, the forestry and tourism sector. So what we're seeing in forestry is, as I said earlier, stability. Production and harvesting are well below where they were in 2016, and they're expected to stay there. And so this means that some value-added manufacturers are likely to have difficulty obtaining fiber, but for the most part, things are expected to be stable. We have seen some closures recently in the north in pulp, but we're not, and some of the primary producers in the northeast, but we're not expecting that trend to hit the southern interior. That's the sense from talking to the forestry guys is the southern interior has gone through that already. Now, turning to tourism. This is, I find tourism one of the most interesting industries. It's very seasonal, with May through September being the busy season for the southern interior. In the winter, there are some snow sports, including skiing and snowmobiling, and Big White was quite busy this year, as was Sun Peaks. But it's a regional market, so most of the visitation that's coming here, as I had mentioned earlier, is from other parts of BC and from the Lower Mainland or other parts of the north. And so as borders opened and restrictions lifted, we saw visitation last summer look more like pre-pandemic levels. And so looking forward, there's a lot of uncertainty about what the longer term outlook is going to be. We've seen significant increases in room rates at hotels, which is making it a lot more expensive for people to travel. And there are indications that consumers are cutting back on spending. So that means that they may choose to vacation close to home this summer, or it means they could stay home. And what that means right now for the southern interior, it's not clear. One of the big unknowns is business travel. Business travel remains down relative to the pre-pandemic. And given everything we learned about working remotely, business travel may have become more sensitive to price increases than in the past. So we also know that the air capacity at the Vancouver International Airport internationally has not fully recovered. They're expecting it to recover soon, but it has not yet fully recovered. So that we can't really say anything about mining and agriculture based on data, but we do know that all indications are here that we're going to continue to see stability in the near term. On the mining front, where there may be some increases in exploration due to critical minerals. Critical minerals are becoming increasingly important, related to zero-emission battery production, which should give Kamloops a bit of a boost. It is a mining hub, and as exploration activity picks up, we'd expect to see economic activity around mining in the area pick up there as well. In terms of agriculture, a lot of that, we do know that the craft alcohol industry has continued to expand, and a lot of it will depend on with the crops. It'll depend on what happens with the weather, which is out of our control. So for right now, it looks like we're expecting just stable production. And now let's talk a little bit about housing, which is everybody in BC's favorite topic, I think. One of the really important things in attracting and retaining people to a region is the ability to find housing that is both suitable and affordable. BC's housing market is very sensitive to interest rates, as we've seen over the last year, and as a result, what's happened is we've seen listings decline. So these two charts compare like Kamloops and district listings, active residential listings in Kamloops, to the 10-year average between 2014 and 2023, and then also for the Okanagan region. And so we're seeing that listings are well below the 10-year average. Last year, as those interest rates hit, we saw a real pullback and listings were way below the 10-year average. This year, the good news is that we're starting to see listings come up, which means more supply is coming on the market. We've also seen prices come down a bit. And that's part of what happens when you raise interest rates. And as we're heading into what's traditionally the busiest time of the year, most of the forecasts are that for price stability in the real estate market in BC, not further price drops. And that's a lot of it is about supply constraints, is where it is. So part of those supply constraints, when you combine that with population, that means we're not going to see we're not expecting to see significant price corrections that are going to restore affordability going forward. The only way we're going to really be able to restore affordability is to build supply. And I know that there's been some recent announcements from our provincial government directed at that, but that is going to take time to happen. It's not like you can suddenly just snap your fingers and build and fill the shortage of housing that we've had. We have a significant gap between housing need and housing supply right now. So if you're looking to buy your first home, it's still going to be a challenge. So to wrap this all up, what does this all mean for the Okanagan? It looks like there's going to be a bit of navigating to do going forward as we enter this period of slower economic growth and higher interest rates. The resource industries, mining, forestry, and agriculture are expected to be stable. We're not expecting to see big boosts there, but we're not expecting to see declines as well. There is a lot of uncertainty about tourism and how many businesses are going to survive going forward. I think one of the lessons from the pandemic and as interest rates started to go up was how many businesses were really dependent on a low interest rate environment. So there's still some questions about how many more bankruptcies we're going to see there. The other issue is that a lot of hotels and restaurants are operating below capacity because they can't find staff. So it may say sold out, but that means something different than it did before the pandemic. And as I just said, housing is going to continue to be a challenge. And so for businesses and consumers, there's going to need to be, we're going to continue to adapt to the new labor market that we find ourselves in, and a financial environment with higher interest rates and less reliance on housing for our growth would be where things are sort of pointing right now. So with that, Dan, that's what I wanted to say. I think we can probably start taking some questions.
Sure. So you covered a lot of ground, Susan. Thanks very much. So this is updated with recent stats. So can we make the slide deck available? We can circulate that after. You're okay with that?
Yeah, we can circulate that afterwards.
Perfect. And thanks too, by the way, with the work on the Southern Interior Economic Summit last fall. We look forward to doing that again. Probably I think we're targeting the spring of 2014. So we'll circle back with you on that. I have a few questions, but if those are online, if you have specific questions, please use the Q&A function and we'll get to those as quickly as we can in the time that we have. And if we wrap up early, it's never a bad thing to give people back a little bit of their time. I do have a few, and if you have specific ones on sectors, Susan can flip back to some of the slides and answer some of that. But one of the things that struck me in the presentation, Susan, you're showing bankruptcy and what data and indicators we look at, and I was curious whether you track consolidations and mergers and acquisitions with respect to indicating kind of how businesses are faring. Because one of the things that we did see, and we've said this repeatedly, the pandemic didn't treat everyone equally. It didn't treat individuals equally. Women were in the workforce were extremely hard hit and impacted. And small businesses that didn't have economies of scale, even within sectors, and even looking at the hospitality side and the restaurant side, some of the larger chains did reasonably well because they had economies of scale. One of the ways, and I'm curious whether you've tracked mergers and acquisitions, is there a trend line of one way you tackle the labor challenges is looking at different partnerships. Are you tracking any of that data, or are you aware of that? Has that risen as a outcome of the pandemic first, and then by extension, inflation, tight labor challenges?
That's a really good question, Dan. Unfortunately, there is no data on that. that you can really track. How we usually look at that and how we're tracking that is you look at the business counts and the size of the business. So Stats Canada twice a year publishes the number of business counts in each region by employment size. And so where you can see some of those trends is if you look at the change in the number of businesses over time and whether those businesses have like there's maybe fewer businesses, but they're bigger. They have more employees. And there has been, I know that there has been a little bit of that, but I think we're pretty early in sort of we're sort of in that first part of the readjustment as those businesses that were sort of ghosts hanging on during the pandemic and as government funding and government supports were pulled back, we started to see those businesses fail. And so I think that if we're going to see those kind of mergers in that, we're not going to see that in the data that we have available to us for at least a year.
Yep, and I remind folks too, and we do have some questions coming in. Please, we've got about 15 minutes or so. Susan has graciously provided her time. So if you have any questions, please use the Q&A function. I'll ask one more and then we'll go to the questions that are coming in. One of the things that strikes me on the tracking the demographics, part of that, and you may have referred to it because you did talk about inflow of youth. You know, we saw an acceleration during the pandemic of people moving to retirement. They said, okay, that's it. This is my time. But that's not just in BC and locally, those that were here. It's also accelerated. And we saw inflow from, you know, the prairies as an example, and from Ontario of, okay, I'm going to retire. Now I'm moving to BC. So, you know, population is growth, but part of that is what demographics are moving to the region. Did you have specific information on demographic shift for the Thompson Okanagan as an example? One of the things, as you know, by an extension, is we want to attract more newcomers, more immigrants, and traditionally they've gone to the big cities. But any data that you've seen on? Yeah,
there is actually data, and what we see when we look at Thompson Okanagan, and like you can get the information sort of at for certain municipalities as well. What you see is that people coming to BC, people coming to the Thompson Okanagan and from outside of other parts of Canada, there's actually more younger people, more people of working age coming now than there was 5 years ago. So we are seeing younger people coming. People moving to the region from within BC tend to be older, tend to be closer to retirement. So there is still retirees coming. Most of those would be from BC. Some of them are coming from other parts of Canada, but the biggest group is coming from other parts of Canada, and it's younger people. And they're coming for like lifestyle, and you know, they want to be able to buy a house. At one point you could buy a house, but of course we have enough people now, it's hard to buy a house. So those are the trends that we've seen. The big thing last year, as I said, was the immigration. We saw a huge influx in immigration, and the question, and going forward we'll continue to see high levels of immigration because of our immigration targets. So yeah, that's what's happening here based on the data as of December of 2022.
All right, so we've got a number of questions. I'm going to go to Susan, so don't worry, I'll just read them live here. And if you want to maybe drop the slides so we can just see it a little bit better, and if you want to refer back to a slide, we'll bring them up as the questions come in. Duncan, thanks for the question. What is the trend data? This is his question on American or U.S. visitors to the region, and how does it look going forward? Did you examine some of that? And traditionally, that's been one of the key markets, right?
Well, actually, it's about 10% of the market is U.S. The rest of it is Canadian. There's a very small amount of international travel, but about 10% of the market is U.S. visitors. For some properties that really cater to that market, it's a lot bigger, but of the visitors coming to the region, it's 10 to 11% traditionally of the U.S. We are starting to see some U.S. travel come back. It's still below where it would have been pre-pandemic, but it is starting to, and inflation's hitting the U.S. as well as Canada. So that's the big influence on visitors to Canada from the US is how the US economy is doing. The exchange rate doesn't have as big an impact on them as it would on us traveling. It's really about when the US economy is growing, people from the US travel, they come to BC. But it's probably somewhere in the, right now it's probably about 10 to 15% of the visitors coming.
A couple times you had mentioned in your presentation the impact on the tight labor and participation rate on wages. So there's a question that's come in with respect to any information on living wage and the impact in the Okanagan, and if you have a general, because for a long time it's been there's a sunshine tax traditionally. If you want to live in this great place, you're willing to take a little less, but there's been significant pressure on that. So are you tracking any data that would answer, is it moving? I mean, there's pressure there, right? But
there's certainly pressure there. And I know that a lot of employers are struggling with what to do and how to respond. I know that there's roughly wages went up by about 3 to 4% last year across the province. And the data is typically only reported at the provincial level. Where we saw most of the rise in wages was sort of at the lower end. There was like for a lot of the service positions, and we're also seeing increases in minimum wage. So that's putting upward pressure on the lower end. There's also some in sort of the middle and higher end wage increases as well, but not quite to the same level as it. And I think employers last year were struggling with like, how do we respond to this? But now this year they're sort of looking at more increases. So we're expecting to see increases again this year that are well above that 2% that we would have expected, but sort of in that 3 to 4% in line with inflation. And so with the living wage, what that does is it raises, if you're raising your cost, you're raising your prices, it continues to put pressure on prices when you start to do that. So the living wage is going up for sure. We've also heard from employers, particularly in the food and beverage industry and some service sectors, that the level of the living wage, it's really hard to be a living wage employer because they're competing. Smaller businesses don't have the scale, so they're competing with the big companies that have scale and can invest in automation and that. So it's a tough thing for employers to do. But yeah, we're looking at wage growth of 3 to 4% would be our forecast right now.
yeah, it's interesting. It strikes me too, the more you dig into data, the more data you want, because there's a couple of areas that would be interesting to dig a little deeper here, and maybe a subject for another session with you, Susan, but we'll carry on here. And there's a question similar to that with respect to the minimum wage, and there's a pretty significant jump that's going to occur here as of June 1st. From our perspective, with our 1,000 members, it's only about 5% of our members are going to be impacted, but this is a pretty significant jump in the minimum wage. We've certainly suggested, how quickly it is, and now tying it to inflation and lack of consultation, it's going to hit some small percentage pretty significantly. Are you getting any impact from your clients, or any data that that's the question around? With it set to increase in June, how will it impact particularly the retail and hospitality businesses, do you expect?
Yeah, that is going to continue to put pressure on retail and hospitality businesses. And it's the question of, for many of them, it's squeezing their profit margin on it, because they're dealing with a lower capacity as well. So it's putting continued pressure on the profit margins for these for small businesses. I think that one of the things that it's at some point you have to make that, you start to look at how can we do things differently. Do we really need to have somebody, a hostess, or can people just seat themselves? And those are some of the things we're starting to see. That's in response to labor shortages, but it's also in response to the cost of labor. It's also, we're also seeing businesses start to look at automated solutions. So maybe you're doing, you've got self-checkout if you're a retailer, or you've got, you're paying your bill at your table through some sort of an app, as opposed to, the waitress you have wait staff bringing you your bill and everything. So that's the sort of that's the sort of reactions we're starting to see. And the investment in automation is not something that small businesses can make. So they're doubly squeezed. Their competitors are able to, maybe the larger competitors can make those kind of investments, because with investments in automation, there becomes a lot of administration, a lot of security, and all those things. So it really does squeeze those smaller mom and pop businesses.
Yeah, we just recently did the CDAP presentation. So the federal government has initiated some work that's digital transformation, right? So it's one of the things that we're hearing. The other thing that strikes me, Susan, just for those that are here, and I think we all, if we like small business as consumers, we need to adjust what our expectations and continue to support those small businesses, even if it means I have to go get my own coffee rather than being worked, because that's helping small business, because they're having to make those adjustments along the lines that you've said here. Couple more questions for you, and Jackie, thanks for the shout out. Appreciation for Susan spending the time here. A question come in: do we have a sense of the impact that financial trends, higher interest rates, particular, et cetera, are having on private capital investment, particularly for investment-oriented SMEs, clean tech, startups, et cetera?
I haven't seen, we don't really have any information on that. We have seen a lot of investment in tech. There's been a lot of subsidies, a lot of support for clean tech to support the transition to to net zero. But I haven't seen any data on the private investment and what's going into clean tech. So sorry, I can't answer that question.
Another one from Rayanne. Looks like the question: you spoke to tracking bankruptcies, but curious to know if any data is tracked regarding new business development. And I think you slightly referenced it. How many new businesses are starting, and what the trend lines are?
So there hasn't been updated data released since the fall. For that, it generally gets released in the spring. So we haven't seen what that looks like, but there is indications that we are still seeing business formation sort of in line with pre-pandemic levels. So we are seeing businesses starting at sort of similar rates to what they were pre-pandemic. Whether so that's based on sort of the data from last 2022. It'll be a little while before we see if that continues into 2023 when the new data gets released. The interest rates could certainly have an impact, particularly on people's ability to come up with that startup capital.
All right, I see Paul has raised his hand. Paul, if you want to ask a question, you can put it in the Q&A, or even if you have a comment, you can use the Q&A function and I can read it, or I can ask my team that's working behind the scenes just to have a quick chat with Paul. If he has a question, we can do that. But this will be the last chance, and then we'll wrap things up. I wanted to come back a little bit, if I could, on the housing side. And one of the curious things I was looking even on the listings there that we're tracking is Airbnb versus short-term versus long-term, and how that's impacting the market. And I don't know if you have a comment or an observation, but one of the things traditionally, those like me, getting close to that retirement or slowing down, you look at maybe liquidating your asset and the house and using that. But now you go, well, there's not much risk if I go Airbnb and rent it out, and I can go away for 6 months and it becomes a revenue producer rather than putting it back onto the market. Do you have any, or have you seen any stats of Airbnb versus the traditional hotels? Because I've had this discussion with hotels too, right? How is it impacting the tourism industry, and how is it impacting the rental side? Because for younger workforce, the rental costs are pretty significant, in particular here in the central Okanagan. Well, at a time we want to attract more young people, right? So are you seeing any impact on Airbnb and onto those sides of our environment?
Yeah, I think that's a big data gap right now. I think I know that in talking to the Kelowna Tourism, they did have a little bit. They were looking a little bit at that and how that fits in. I know that the work that has been done shows that it's a relatively small component of the market. I know in Vancouver when they did it, it was small. It wasn't as big as everybody thought it was. but it does take supply out of the rental market. The question is, would that property be rented or would it be sold? So that's the question, and so there's not really a good answer to that. We do know that most people do still stay in hotels. It's a relative Airbnb is still a relatively small part of any particular market, but it certainly is it's a good question. Is that keeping stock out of the rental market where we need it for young people who are trying to get started?
Yeah, it's interesting the comment about business travel may be more sensitive to price point, because we have a conference coming up and hotel rates. Wow, okay. How about Airbnb as an option? So there might be a little shift on those that are price sensitive in the business side, right? But
Absolutely.
we have one more question, Susan, then we'll wrap things up here. And it's interesting, this one. I don't know if you have a comment of it. Do you see that people becoming social media influencers is a cause of labor shortage? And I'll preface, I think I was reading somewhere stats in North America, the #1 pursued career is social media influencer. And in Europe, no, sorry, it was in Asia, was a lawyer or an accountant. But in North America, #1 pursuit for you. I'm not sure that's saying something about Western culture or not, but are you tracking anything like that, career choices and data that's influencing? And
we do know that there's certainly what's interesting when you talk to employers is there's certain industries that have no trouble attracting people regardless of what the labor shortage. I'll give you craft distillers. Working at a distillery is an appealing job for a lot of people to say, whereas if you're talking about maybe working at just a commercial bakery, not so much. So there's some of that. I don't think social media influencers is pulling a lot of people out of the market. There's certainly some people that are doing it. They may be doing it as a side hustle, but we are seeing certainly a lot of entry into the labor force with youth. I think one of the things that is less common now, and we see this with cars as well, is that young people and teenagers aren't as likely to get part-time jobs, and so that used to be a big source of labor for a lot of retailers and fast food places, and so that there's not as many people are getting jobs as they used to before they go to university. So that's certainly a change in the labor market. I don't think that necessarily means they're social media influencers. I think they're just making that choice not to get jobs. And if anyone can tell me how to get my kids to get a job, I'd really appreciate it, because I've been trying. My son, my 19-year-old, still hasn't got a job. He's in university, and I keep telling him he needs to get some work experience. But that's certainly a trend that we're seeing as lower rates of labor force participation among sort of youth.
yeah, well, it's interesting. I'll put a flag on the side hustle that you mentioned, because I'm hearing that from more and more, that because the technology and opportunities and the variety of skills some of the youth have, lots of side hustles, and I'm not sure if that's tracked. Well, I don't want to digress because I want to wrap things up here, but I'll put a flag on. If you ever come across data, I'd be curious if there's a growth in side hustles because of the technology. It allows me to much broader potential contract opportunities, right? And different workforce depending on your skill set. One thing to wrap it up here, and if you want to make any final comments, Susan, as we wrap up, would there be one takeaway that you would share, or advice you'd give small businesses in the central Okanagan or the Okanagan region based on the data, something that they got to keep an eye on?
I think that the thing that jumps out at the data is, this is a time to be sort of cautious of. I would be very cautious about credit right now. We're looking at stability, but credit conditions are not favorable right now, and so looking at how you can avoid increasing your debt load right now is probably a wise strategy. I know some people in inflationary environments say you should. This is the time to devalue your debt, but I think for small businesses right now, it'd be sort of, stability is coming forward. If you can keep your debt load manageable, you can weather the storm.
Awesome. Susan Mowbray has been our guest, partner with MMP in Vancouver, sharing a lot of data. We will share the slide deck and the information with all of those that have participated. We'll likely follow up and would ask those that have joined us. We're going to ask for a little bit of feedback on timing and do you like this type of programming and information? So Susan, thanks very much for joining us. It's been a pleasure to have you here and we look forward to hearing from you again.
Yeah, thank you for the opportunity. It was nice to chat with you this morning, Dan.
Awesome. Thanks very much. We're going to wrap things up and just to let you know, we've got some more programming available for you. If you want to check out our website, we'll share the links to the video once it's been produced with all those that have joined us. And also, if you haven't signed up for our newsletter, make sure you sign up for our newsletter and we'll have lots more of this type of content. Thanks very much for joining us today on the state of the economy for the Okanagan and wish you well for the rest of the day and the week ahead.